Welcome to the Ceilings Trader Group. This is our video series on how to get started trading in the stock market so that we can get off of the roller coaster ride. And basically, we're putting you through a basic trainings. We have a series of videos that are taking you through the steps to get started in the stock market, and go back to our site and see what you need to catch up on. But today, we're going to focus on developing a trading plan. Okay, welcome to the second day of our study of the psychology of trading, and we're using the book Trading a Zone by Mark Douglas. And Mark has an exercise in chapter 11 of his book called Learning to Trade an Edge Like a Casino. And obviously, if you haven't read the book, you might say, what do you mean trading an edge? And basically, trading an edge is like your opportunity, being able to identify opportunities as the market presents them to us on a daily basis. He calls those edge an opportunity, new trades, new entries, new exits. Those are our edges, according to Mark Douglas. And he has a exercise here where it's designed to help train your mind to learn how to interact with the market, and more importantly, to learn how to be a consistent, disciplined trader, to follow your rules, be your rules, and let your rules be you. And so what he's saying here is basically choose any market and choose any stock, and it must be a liquid stock, which means it has a lot of volume, it trades very well, and also has a good daily range, and being aware of any margin requirements. And this is if you were doing it for real. Now, I'm not saying do this for real. I'm recommending that we paper trade this. And there are plenty of stories out there of people. I can't remember the guy's name, but there's one guy who came a millionaire trading IBM. That's all he did, IBM every day. I myself, from time to time, will get locked into looking at Goldman Sachs every day, or Apple, or when different opportunities aren't presenting in other markets, I might go in, because you want to learn a heartbeat of a stock. But we'll talk more about that when we get to our trade plan. So after we've chosen that market, we basically have to come up with the way that we're going to trade that one stock. So basically, you need to come up with your trading system. It could be a fundamental, it could be a technical, mathematical. Doesn't really matter about what type of system you choose, because it's not about the system. It's not about your ability to look at a chart and visually say buy. And it's not about whether or not you make money or you don't. This is about, can you put a system in place and follow that system no matter what, and continue to trade on the next day. So the basic requirements of any system that you choose to follow during this experiment is to define what are your trade entries, where did you put your stop loss, what time frame do you use to identify your entries and exits, how do you take your profits, trading in sample sizes, how do you test this system, this trading system, and have you accepted your risk. So when we're talking about the trade entry, he's basically saying that the variables you use to define your edge have to be absolutely precise. You need to say that every time stock Y hits the 20 moving average in an uptrend, I buy. Every time MACD crosses over, I buy. Whatever it is, and again, it's not about the validity of whatever it is. You need to come up with your set list of rules, your set list of entry signals that says, this is when I'm going to buy this stock. If the market is aligned in a way that all of your rules meet together, then you have a trade. If they do not, then you do not trade. You're trading exactly what you set up to be your entry rules, and you do not trade when they do not happen. The same thing happens with your getting out as it is getting in. People need to have a defined rule. What happens when it breaks the 20 moving average, when it breaks the 50 moving average, whatever it is, you need to have as clear defined exit as you do entry. And that also has a lot to do with profits, especially when the stock is going in your way. So your system must tell you exactly how much you need to risk to find out if the trade is not going to work. And that's simply saying when you follow your system and you enter into a trade, what are you willing to do? How long are you willing to wait? How much money are you willing to risk to see if your rules got you into a winning position? There's always a point where your trade's not going to be profitable anymore, and it's better to take a loss than it is to keep waiting it out to see if the market comes back in your way. Time frame. Your trading methodology can be in any time frame. I use the 5-minute chart, the 30-minute chart, daily charts. Use a lot of charts. However, Your entry and exit signals need to be based on the same time frame. If you use a 15-minute uh, uh, chart on a daily, intraday basis to get in, you need to use that same thing when you get out. Um, Remember that the trend is your friend, and basically that the lowest risk trade. Mark Douglas goes on to say that the lowest risk trade has the highest probability of success is when you're buying on dips in a clearly defined uptrend, or you're selling on rallies in a clearly defined downtrend. So um, the trend is your friend, but more importantly, use the same chart that you use for your buy signal as your sell signal. Taking profits. This is one of the hardest things because I've been in plenty of trades where I was up and then suddenly I'm getting out, with a lot less profit than what I had. So in a winning trade, you never really know how far the market is going to go in your direction. This is probably one of the hardest skills to develop. Once you develop the right mindset, knowing how to take your profit, take your money, and run, know when to fold them is one of the hardest skills to master. Markets rarely go straight up. A normal market moves up and down and retraces. So knowing when this is just a normal proportional retracement bouncing off a moving average, or when it's just all all hands on deck and the market is about to tank, or if you're in another position and the market is about to rally, knowing that difference is one of the hardest skills to take. And we're going to talk about buying and entry decisions later. We're going to talk about our stops later. But again, in this system, we want to set up what our clearly defined rules are going to be. Finally, not finally, trading in sample sizes means that we need a systematic approach to understand what is and what is not working. Um, Another way to talk about this is capital management. We don't put all of our money on one trade. We don't put all our money in two trades. You want to spread your money out in different sectors and make sure that things are um, evenly spread out so that if the tech sector goes down, your whole portfolio is not being wiped out. Although of course we're going to have rules and stops to get us out, but still. And testing kind of goes along with the previous one here of um, your trading sizes, and that is how many trades do you make to test whether or not your system is working. Um, Once you decide on a set of variables that conform to these specifications, you need to test them to see how well they work. A typical trader practically lives or dies on the results of the most recent trade. If it was a winner, he'll eagerly go back in the trade. If he loses, he won't. So you need to test your system out. This is why I'm saying we're paper trading right now, so that you can clearly answer the question, why did you get in that trade? And if you can say, this is my rules, then again, you can say that I'm not wrong, my system was wrong, and I may need to test some changes because the market condition has changed. Again, markets go up and down. They rarely go straight up. They rarely go straight down. This past couple weeks have been so volatile, and especially trend trading and long-term trading, wouldn't work in this market because they're so volatile. Accepting the risk. Do not change your established risk parameters just to satisfy your comfort levels. Knowing the risk and accepting the risk are two different things. And so the basic point here is, again, understanding your trading sizes, testing it out, and then knowing how far you're willing to risk on a trade before you say it's time to get out. And we talked about that earlier with the stop loss. Doing the exercise. The rules are pretty much simple as the purpose again of doing these steps is to help you become systematic, follow your rules, and let your rules lead your trading. Um, so trade your system exactly as you have it designed. This means that you commit yourself to trading at least the next 20 trades based upon the system. Not just the next trade, but the next 20 trades. No deviation, follow your rules. Once you're able to do that, you're beginning the process of just realizing that A, more than likely your system works if you just get the heck out of the way. And B, you'll get in the habit of making the adjustments that you need and being able to look at the market as opportunities and not as a, a system that has a vendetta out to get you. Now we're going to talk next about trade plans, and we're going to talk a lot about the individual parts of this as far as identifying um, buy and sell signals and technical analysis and trade plans. We're going to talk about more of that as we move on from here. But these are the steps you need to do to set yourself up to developing the right mindset. And again, this was developed by Mark Douglas in the book Training in the Zen.